Okay, it's 10:05. Good morning, guys, and welcome to Call Mortgages. Today, some of participants are not from Call Mortgages, so we just want to welcome all of you to learn about private mortgage brokering. So today's session, we are going to talk about private lending in detail, what it is, why people go for it, what is included into it, how to calculate the LTV, how to calculate interest calculations, and all of this stuff. And the most important stuff that's going to come, we were going to do it, but now we have given it to Dan Pauls from Brightpath. He is going to talk about how to close a private mortgage, right? What you should be considering. It's not only the best thing these days because private mortgages are becoming increasingly popular among Canadians who are looking to secure the loan to buy a home or for equity takeout, especially for those borrowers who are not approved for any reason. For those borrowers who are not approved by these banks and due to different reasons. For example, due to stringent mortgage rules, credit issues, non-traditional down payment, unverifiable income. There are so many different things that they cannot get qualified with the traditional banks. So we are going to do two-part webinar series. First part is going to get done today, and we are going to bring some more lenders. So we are trying to cover everything from A to Z about private mortgages, so you can learn a lot how to do it. And private mortgages are gaining market share, I think, in leaps and bounds. Last year, I think overall market share, it is close to like 30-40%. So it's gaining and it's going to gain more if government is not going to change rules. Kuljit can talk about it because he is a regional director for MPC, what these people are doing at MPC. So he can talk about it. So today is going to be a jam-packed session, and we are trying to make sure that we try to give you all the information at a pace that you can learn, right? So having said that, Kuljit, if you can do the industry update, what's happening. And guys, one thing more, we are not going to do the deal or deals of week due to the pack session because after last Thursday of every month, we are going to do a roundtable. So we are going to discuss those deals in that and saving all this time to focus none other than talking about private mortgages. Kuljit, over to you.
Thank you, Paul. Thank you very much, and welcome the new members from the other communities. We have agents far off, from 1,000 kilometers away from here. Welcome. And as I said, like in the last meetings, we discuss deals of the week and what's going on in the market and everything. So I will start with. Let me share my screen. I'll start with a little. What happened? Are you sharing your screen,
No,
Paul?
no, Kuljit, you can share your screen.
Why it's not coming?
I saw you have shared screen, but then you turn it off.
But I can't see it.
Yeah,
Okay.
because
Now,
I can't see it either. Now we can see it. Yes, please.
okay. All right. All right. So, as we always say, like what's going in the market and everything, there are a few things which we specifically want to discuss today. One is, of course, everybody knows about the housing sales. So, housing sales are 52.4% up year by year. That means, let me just close. That means, from past years, it's going up and up. 52.4%. That's huge. And this data is from TREB. 6928 houses were sold. Average selling price for the home sold in the region means wherever the TREB is, TREB region, Toronto Regional Real Estate Board, in the month of January. And it is up by 15.5%. And the average price is 967,885. Almost a million, which is crazy. Yeah, and this is scary as well. And with this present situation, what's happening in the market? Market became competitive due to very low housing inventory and the low interest rates. So combination of both right? It's motivating the buyers to buy. Plus, some buyers think that the inventory, there's not many houses are coming. Some people are waiting and waiting, and they are forced into the bidding wars. And it is everywhere. It is not just in GTA and surroundings. You go Ontario Southwest, like Niagara Falls, those areas like Niagara Falls, St. Catherine, Thorold, Welland, those were like dead areas. And now, they are hot. Yesterday we had like a seminar or webinar I should say with David, and he mentioned about KW, Kitchener Waterloo area, and that's also like 800,000 is the average price over there. Why? Because the houses, those were 600 or 590s, 580s almost a year ago. Now they rose up to 800,000. So the whole value has gone up. Okay, so that's what is happening in the market. And as a mortgage agent, what we got to do in this heated market, we have to ensure that we have a discussion with our borrowers around going in firm on a house offer. So whosoever you are working with, like pre-approval, pre-assessments, okay? Yes, it seems everything is okay when you are advising them. Your GDS and TDS is well within the line. However, going firm is not advisable. So as I said, important advice what you have to provide to your clients, caution your clients in writing. In writing, I stress it again, about going firm during the bidding wars. Please ensure to tell your clients that you cannot predict what the property will appraise for in this crazy market. We have seen the properties listed like 550s or 580s or something like that, and is going for 720, 800s. The difference, the gap is like 200,000. How can you predict that? That if it goes to the insurer, that it will go through their evaluation system, automated evaluation system. How can you predict that? We don't have data. Even though they have a pre-approval, pre-assessment done by you or done by their bank, you cannot just dwell on whatever they are telling you. Okay? Give them in writing that you do not advise to go firm. Even though they have a purchase agreement in place that shows the value there. Yes, they bought it during the bidding. They opted for it. Their real estate people are advising that this is the listing price, this is the average price in this area, and now you want to go with this or you want to go with the higher value. This is between them. We are not part of that discussion. So from our side, what we can advise, please put a finance condition there. Do not go firm. In last 21 years, we never ever advise anybody to go firm. MPC update, as Mohinderpal said, MPC Board of Directors, we had a meeting last week, and in the month of February, starting 22nd, we're having the rounds with the local MPs, and then collectively, director from MPC who is responsible to meet the government, collect all the information from all the board members and the regions like Ontario, Quebec, BC, and so on, and then we will present that over to the government. So what we are trying to do, and that question was raised by me, or suggestion was raised by me, the very first meeting what we had, that the 2% ratio, like whatever we have right now, the Bank of Canada key rate is 479, and the going market rate is what? Like say average like 179. I'm not talking about 159s or 169s. Let's say 179. So the difference between that is what? 179 plus 2 is 379. Why we are still qualifying each and every borrower based on 479? That is throwing lots of Canadians out of the window. Why? Because they cannot get approved. Especially for those who are going for 5, 10, up to 19.99% down payment, means the insured mortgages. So this is the big thing what we are pushing, and it affects whole industry. Not one reason or two. Okay, this is what we are doing, and we're having a meeting with the with the local MPs. Rates. Current rates, insured high ratio, fixed 1.59. Who is offering that? That is Equitable Bank. For insured mortgages means less than 20% down. And you can buy it down to 1.44, or you can go with Attain. Attain is offering 1.44. We had presentations, in last week or previous week. David has the same thing. So 1.44 is available. You can beat the HSBC rate with that. Okay. And variable rate on high ratio mortgages, prime -1. And that is again from Equitable Bank. The prime is 2.45, -1 is 145. Then insurable. Insurable means you have 20% or more down, okay? But it could be insured. Why? Because it falls under insurance guidelines. And the amortization is 25-year for all insured mortgages. So I'm providing here the range. Fix between 1.84 to 1.94. Equitable, First National, they are the lowest rate at this moment. We can get it from Scotia as well, but these are the two very competitive rates. Variable rate, prime minus 0.85, that means 1.60. And then we have conventional. This rate is only for 25-year conventional, 20% down or more. Fixed rate is 194 to 199. Different lenders. Okay. First National, Scotia, TD, they all offer in that range. And variable rate is prime minus 0.60 to 0.86. This is the conventional rate. And with this, as I said, there will be no deal of the week because we have jam-packed sessions today. That's private mortgages. We have Dan Paul coming today. And Mandapal, back to you.
Thank you very much. Guys, could you see the screen?
Yeah.
Yep.
So let's dive right into it because we, like Kuljeet said, we have a jam-packed session and we just want to make sure we cover it well within time that we have it today. So as I mentioned, there is going to be two-part webinar series today and next week, February 18th, right? So first of all, we need to understand that what is private mortgage brokering? That is the most important thing that people need to learn, right? So private lending is becoming increasingly popular that we talk about, and I talk in the beginning as well, among Canadians looking to secure loans to buy a home or equity takeout, right? It helps borrowers who are not approved by traditional financial institutions due to different reasons. And those reasons could be stringent mortgage rules, credit issues, non-traditional down payment, and unverifiable income, right? So what is a private mortgage? A private mortgage is an alternative source of financing given to a borrower when a traditional bank or an institutional lender does not approve for any reason a borrower for a mortgage. Now, what are the three most common sources for private funding that we are going to talk about, or from where the private funding is sourced? First is private individuals. Second is mortgage investment corporations. And then a group of individuals, they do syndication. And I just want to let all of our agents know that Akal Mortgages does not participate in syndicate mortgages. It's very, very, very important for you to learn. We do not participate in syndicate mortgages because of the nature of the business and risks involved with that, right? Now, why clients need a private mortgage? We talked about different reasons in the beginning. For any client, right, who do not fit into any guidelines of A or B lenders, what could be the reasons? Poor, bad, blemished credit, income verification, untraditional way of declaring income, like for self-employed who are taking a lot of deductions at the end of the year while they file taxes, right? Buying a not traditional property. There are so many different properties that are not banks and traditional lenders do not like it. right? And after that, they need quick money. There's no time to wait for traditional banks. And what do I mean from that? But typically speaking, um, banks need 10 business days after all conditions has been met by the borrower, right? So everything is waived, all conditions have been met. Typically speaking, banks and all other traditional lenders need at least 10 days to do that. But people don't have the time, they can opt for this mortgage. Need a short-term mortgage, and that could be to consolidate debt, renovations, credit repairs, etc. Right? Also, we are going to take some of the business cases down during the presentation as well, so you can really see how to work with the numbers. Right? Pay off property tax or income tax arrears, stop power of sale and foreclosures. Right? Equity takeout for any other reason, like they need the quick equity takeout for deposit, for down payment, for other property. I think last year about 5 to 10% of second mortgages or private mortgage do account for where people are looking for the money to give the down payment for the other property, or they want to book a new property and they're looking for deposit. Not breaking first mortgage, it makes sense that their first mortgage at a decent rate, and if they break that, there's going to be huge penalty, in some cases anywhere from $7,000 to $32,000, and refi doesn't make sense. In that case, you can opt for short term. I just want to make sure that everyone understands that private mortgages are short term solution. And the most important thing that Dan Paul is also going to talk about is all about exit strategy for your client and for your lender, both. It needs to make sense in order to get into a private mortgage. There must be a purpose. It is a purpose-driven mortgage, right? Now, what are the benefits of private mortgages? Very similar to why they're not being approved. The outcome is like why they do that is the benefit. Quick, fast approvals, quick closing. Like we have done closing next day with some of our private individual. This is how quickly closings can be done. This is not the norm, but this is one of the benefit of private mortgage, that you have to do it because there's a minimum time that Kuljit is going to cover it from the actual from law perspective. How much minimum time do you need to give to your clients? 24 hours. They can waive if they want to do that, but we're going to talk about it. No income requirements, no minimum credit requirements, non-traditional down payment. Like some people buy it, take the gift and that's returnable. If you want to do the same thing with the traditional lenders, they will not approve it. So non-traditional down payment we are talking. Help rebuild and repair your credit. We will talk about it when you are going to consolidate your all the debts, unsecured debts, and that's really hurting you, not only your cash flow, but also hurting your credit, because one of the biggest factor that impact your credit is 30%. 30% if you have maximized all of your credit. So very, very important for you to understand that if you go more than 75% of your limit, then this is going to impact your credit 30%, right? For mobile homes or micro condos, less than 500 square feet, traditional lenders don't like it, and not all lenders do that. Traditional lenders do that, right? So that can often cannot be refinanced through a bank. So
I'm sorry to interrupt here.
And for investment properties, second mortgages, for investment property, some people buy homes, right? And they simply want to quickly renovate it within 6 months and put it back into the market and sell it for profit. So in that case, private mortgage is the best option to take that, or even to take the second mortgage on the existing property and do the renovation and then sell it. It can be first mortgage or it can be second mortgage. Now, what is meant by first mortgage and second mortgage? The reason I brought this slide last night, because some people, some of the participants are not from Akal mortgages. And I just want to simply give you the definition of the first mortgage. A first mortgage is the primary loan or initial loan obtained on a piece of real estate. If the home is refinanced, the refinanced mortgage maintains the first mortgage position. Even if there's a second mortgage, and there is a term that is called postponement. The second mortgage lender needs to accept that postponement clause that they will still stay at second position. So first mortgage, it will still register at the first place. So why we call first mortgage, second mortgage, third mortgage? This is the sequence of how these mortgages are registered on the title. So whoever is going to register the mortgage first time, first, then second, then third, and then fourth. There's no other difference on that. Even line of credits, majority line of credit, if this is not part of the total global limit, those are also registered as second mortgages. So some people say, oh, no, I don't want a second mortgage. But you need to understand that what people are really looking for. Some people are calling even second mortgages that they want to buy another property. They already have a mortgage on their principal residence. They call, now I'm looking for the second mortgage because they want to buy the second property. So it's very important for you what people are referring to second mortgage. Is this really truly a second mortgage? Don't simply start like talking about the second mortgage, but first look for their need. And that's what we are going to cover in the presentation today. Right? What is the second mortgage? Now, a second mortgage is type of a subordinate mortgage made while an original mortgage is still in effect. In the event of default, the original mortgage would receive all proceeds from the liquidation of property until it's all paid off. A second mortgage is also called a home equity loan as well, if this is taken as the second mortgage, right? Now, typically speaking, just want to give you an idea that what the first and second private mortgage are used for, right? So typically, I just want to let you know when you're looking for first mortgage, you're looking for, if this is not refinance, if this is purchase, then there are down payment requirements that you have to keep in mind. And when we are talking about taking the equity out or refinancing, then there's an equity requirement in that. So down payment is actually the money that you put down while you purchase, and equity requirement is that either for first mortgage or second mortgage, that the money that you leave behind in the property, that's called equity requirement for private mortgages. So first mortgage can be used for purchase, investment properties, consolidation of debt, and we are going to talk about all those examples during our presentation. Equity takeout, VTB. This is one of the type of the mortgage that people normally take it, and we had helped in the past people even to arrange the VTB, especially for the lender and borrower both. Construction financing. I just want to let you all know, in last 21 years of our career as mortgage brokerage, guys, we have never done any construction finance for residential on residential side with any traditional bank, right? We have construction financing done by our MIC companies and other individuals who specialize into construction financing. So it's very, very important for you to learn. We are going to do a special webinar about construction financing probably next month. And we are going to cover exactly what is required, who are those lenders who specialize into construction financing, right? Land purchase. And on the other side, why people take the second mortgages, there's the equity requirement, not breaking first mortgage, debt consolidation, right? So these are the major use of the private mortgages. And now, where you find private lenders, and this is for all mortgage agents, guys, with Mortgage Alliance call mortgages, you find majority, not all, but majority of those lenders and money market under BOSS. If you want to submit deal through BOSS, then if you click on money market, the deal will go through all, I think, 32 or 34 different lenders on BOSS, right? If you have a relationship, then you can also send the deal one by one. But if you do not know, then simply one submission can end up going to all private lenders on BOSS. Second thing, Mortgage Investment Corporation. How do you work with Mortgage Investment Corporation? Dan Paul is going to talk about it. And then individual private lenders. Folks at Call Mortgages, we have an approved list with Call Mortgages where we have all those private individual lenders. When they do not fit into any of the MIC or the money market, then we always send the deal to those lenders and they quickly close for our team, right? Now, what are private mortgage products? Like first mortgage, second mortgage is not only the like couple of products, but you have to understand that there are different ways of putting up the mortgage together. So we are going to talk about different mortgage products. So there's first mortgage we talked about, right? There's a second mortgage that we talked about, but also there are bundle mortgages, right? What are bundle mortgages? That is the combination of the first mortgage as well as second mortgage both. So first mortgage, typically speaking, companies will do up to 65%, 70%, 75%, 80%, and then there will be second mortgage behind for 5%, 10%, 15%, 20%. I'm just giving you different examples over here, right? But typically speaking, they do first mortgage up to 65, 70, 75, and then they have the second behind the first mortgage. Same company, same mortgage investment corporation, they will do it, but there will be different rate, or it could be same rate as well, depending upon the mortgage company that we go to. And this is just done because of the risk that they really want to take, because they also have to give the return back to their people who are pooling the money for them. So basically, they're investors. Now, broker compensation, and I brought this topic all the way from the last slide to this slide. Guys, just want to let you know that private lenders or MEC, they do not pay any commission, right? Or any finder fee to brokers. However, they may collect on your behalf. At Akal Mortgages, we have arrangements with many different MECs where they can collect money on our behalf and can pay us directly rather than being paid by the client directly at the lawyer's office. They could collect the money for us. But very important for you to understand, to my understanding, that no MEC pay commission or finder fee directly to brokers, right? So brokers, they charge their broker fee on top of the lender fee. I should say not on top of, but in addition to the lender fee that lender charges from their clients. As a rule of thumb, this is what we are telling all of our Akal Mortgage team members. Like, you need to charge the same money what fee is charged by the private lender. And the reason for that, guys, we have today, like we have a couple of MECs, they are on the call as well. You are taking those clients to those individuals who are private investors or lenders, or you're taking them to MECs, right? They are making money because you are because of you, because you are giving them opportunity, and you should be making the same money as lender is making. But by the end of the day, guys, it is all up to you what you really want to do. And you really have to add value to the transaction. And that's what Dan Pauls is going to talk about, how to close it, right? So the clients must see value working with you, right? They should not be nickeling and dime to you for this one. Okay, no, this is not the rate. You do your best and do the right presentation. They should be appreciative of you for providing them this one, right? So you should not make, typically speaking, as a rule of thumb, less money than lender or MEC company is making, right? And refer to, this is not the previous slide, but we are going to talk about it. Kuljit, you there?
Yep.
Could you talk about the depiction and all of that stuff, because you go on this one every day?
Okay, I can't see the numbers here.
Okay, so we're going to talk
Okay.
about this one.
Yeah, up to 50% LTV. It's a very least risk because there's a lot of equity in the house. And the interest rates, right now, it varies between 499 to 599. But because this is a very competitive market and all the mix are trying to, get more business, into their lap, that's why they're offering some special rates. But typically speaking, it's around 599. Okay, and the fee is 1.5% up to some charge 1, 1.25, it's a negotiations. It could go up to 1.5% each, means the lender fee plus the broker fee. And the next one is 50% to 65% loan to value. It's a low risk as compared to, the high risk, like 80% or something like that. So that's why they offered 599 to 699. So you have to understand the risk, what risk the MIC is thinking when they are underwriting the file. So rate is dependent on the risk level. And the fee is between 1.5% to 2%. Again, this is each. So 1.5 plus 1.5 or 2 plus 2, that is the combination. Between 65% to 75% loan to value, the risk level is it's a moderate, and the rate is 699 to 799, and the rate is 2.23. So 2 plus 2 plus 3 plus 3. When we say each, that means the lender and the broker. 75% to 80%. Majority of the lenders who are in this market here in GTA, right? They say 80 to 75. Some are like a less risk taker, I should say. They say their minimum is 75, and some goes up to 80. High risk. That's why they're charging a little bit higher rate of interest, 799 to 899. And the rate is 3% to 4% each. We're talking about first mortgages here. Okay, don't confuse with first and second, because that's the next slide, second. So 80% to 90%. We have Dan Paul here, who will talk about their products. They could go up to 90%. It's extreme risk for the lender. The fee is between 899 to 999. Case to case basis, they can look at it, like what could be done. However, this is the range they are offering at this moment, and the fee could be anywhere between 3.5% to 4.5% each. So this is just for the illustration purposes only. Negotiation could bring the rate down. Maybe the fee is higher. Right? Some clients are rate sensitive, some are fee sensitive. So we have to see where we can fit that particular person or particular property into their mixed risk level. So this is for the major urban centers, not for the rural properties, not for the town less than 25,000 or 50,000 population. For rural properties, the whole setup could be entirely different, as it will be more riskier for the lender. Next slide, please. Second mortgages. So as compared to first mortgages, second mortgages rates are different. So if the loan to value is 50%, as we just said, it's a least risk because there's a 50% equity in the house. Interest rate between 599 to 799. Okay, and the lender fee is 2% each, means 2 plus 2. It could be 4% charged by the lender and they pay you 2%, or it will be 2% lender, they deduct their fee and you deduct your fee directly from the client. 50% to 65% loan to value. It's a low risk, and the interest rate is between 799 to 899. So lender fees and broker fees is up to 3%. It could be 2.5% plus 2.5. It could be 3 plus 3. Next one, 65 to 75% loan to value. It's a moderate risk, and the interest rate varies between 799 to 899. Not much difference between 65 to 75% because there are so many players, right? And then they have to be very competitive. Up to 4% each. It could be 3.5 to 3.5, both, right? It could be 3 plus 3. Maybe they will have the high rate and the low fee. 75% to 80% high risk. As we just said, the rate will be a little bit higher than 999 to 1199. So up to 12% will be the interest rate, and up to 5% each will be the fee. So total will be like 17% in all together. If we have 90%, between 80 to 90% extreme risk, and the rate could be between 1199 to 1499, and the fees will be up to 7% each. Okay. Again, this is just for the illustration. You have to present the case over to the MIC, and then they have to see what is their risk level, what is the population of that, where is the location. Location is paramount because this is the main thing they are worried about. If something goes south, how quickly they can sell their property. They're not in the business of selling properties or taking over the properties. Okay. However, they have to calculate the risk. So for rural properties, it could be a little bit higher, as we just said. So what equity in a home mean? Home equity is equal to market value. It could be appraised value. It could be the purchase value, right? When we are doing the purchase, it could be purchase value. It could be the market value when we do the appraisal value minus all the liens. So difference between the current value and minus all the liens. It could be first mortgage. If we are doing the second mortgage, we have to see what is the first mortgage behind this. Okay. If we are doing the third mortgage, what is the second mortgage behind it? So this is how we do the calculations. So appraised value, let 1 million, and amount available is 80%. Outstanding mortgage is 600,000, and outstanding second mortgage is 50,000. Available equity to be used is 800. That's the first mortgages minus 600 minus 50, and what that gives us 150,000. This is the available equity to be used. So lender can give you that 150. Out of that 150, you have to calculate the lending fee, whatever the lender is going to charge, whatever the brokerage fee, whatever we're going to charge, and whatever is the lawyer's fee. Mind you, there will be two lawyers, not one. Okay? When you cross 50,000, you need two lawyers. Less than 50,000, 49.999, one lawyer. So we have to calculate, the fee. Whenever we are doing the calculation, we always see what they need in hand, cash in hand. So you have to figure that out, and then you have to do the calculations. Right? What could be the fees? What could be the legal fees? Appraisal they pay upfront, because that's a different. That's not out of this, because they have to pay the appraisal first in order to move further. Next slide, please.
So typically speaking, if the total equity available is $150,000 and you're thinking 5% lender fee, 5% broker fee, which is $10,000. So that should be taken out from there just for the sake of calculations. So 10% of this one is $15,000 plus, like Kulji said, you must have two lawyers, which could cost you, let us say, $2,500, right? So 15,000 plus 2,500, 70,500 plus $500 for appraisal. So $18,000. So equity net in hand will be $150,000 minus $18,000. That makes approximately $132,000. Very, very important for you to understand not only how to calculate equity, but what will be net in hands of the borrower, right?
So interest and payment calculations. So mortgage amount is 150. Interest rate is 9% compounded monthly. Term is 12 months. Total interest mortgage amount times interest rate. That is 13,500 for 12 months.
So basically you have to multiply mortgage amount, which is $150,000 into 9%. That will give you total interest for that term, which is for 12 months, right? $13,500.
So you divide it by number of month, and this will give you the monthly payment.
So understand, this is only for 1 month, $13,500. If this $150,000 mortgage is for 2 years, the total cost, the total interest will be $27,000. So just want to make sure, like I mentioned in the beginning, this is the short term. The private mortgages are for short term, and you really have to see what is the purpose for it, right? Okay, so let's talk about, is private mortgage is going to make a useful solution? We are going to talk about different numbers over here. I am going to talk about from what we see on daily basis, and then Rashmit, you are here.
Yes, I am. Yeah.
Okay, so you can also talk about some of your deals, but let me quickly walk you through What are the different solutions we're going to talk about? First private mortgage, consolidating two mortgages, second private mortgage, which is going to be debt consolidation to improve the monthly cash flow, or just to take the excuse me, equity takeout to start earning fixed income. How that can be done, we are going to talk about it, right? So let's take, first of all, when we are going to consolidate first and second, there are a lot of assumptions to be made based on so many different deals we have seen in the last 20 years. So we are just giving you snippets of those different deals that you can really understand that when clients are talking to you, uh, what are the different directions that you can think about. So for example, there's a present situation for the borrower that their first mortgage is 184. And guys, I said 184, right? They have the first mortgage, which is a balance of $335,000. And let us say their payment at 184 is 1707, right? Then they also have a second mortgage at 12%. And that is the total 150. I'm just trying to relate to the previous example. So they're at 12%. Second mortgages are typically at this rate of interest, right? So $1,500. So their monthly payment is 3207, 3,207, and their balance is 4,000, like $485,000. Now, if we compare, like, we do not know loan to value at this time, right? So we are just trying to take one example. If this is up to 50, 65% loan to value, there are many lenders who will do no lender fee up to 50% or 60%. It starts from zero lender fee. Then you need to charge your fee on that. So let's say we have a total of, if we combine these two, 485,000, and we have to add broker and lender fee. So that can be taken in any shape and form you want, can think of that. It will be 1% lender fee, 1% broker fee, or no lender fee and 2% broker fee, whatever it is. So let us take approximately $9,700. And then there is going to be the lawyer involved as well, right? So total mortgage, I haven't added that. That's a mistake. So new first mortgage at 6%. Now, if you talk to your client and tell them, look at your present situation, but if you talk to them at 6% rate of interest versus 1.84, they may not be able to register it right away. The most important thing for you is to understand that how to sell it, and that's what we are going to talk about, right? So you have to understand that you are going to do first, like a new first mortgage at 6%, and there will be like million of questions why you are putting me from 1.84 to 6%, right? But if you look at that perspective, what is going to be mortgage even at 6%? Only 2,473 versus $3,207. And here we are talking about approximately 734 cash flow per month. Guys, we have seen this cash flow could take care of a lot of stress. It can save relationships and marriages and families. It plays a bigger role on that. But even if you look at 734, although the new first mortgage is only going to be interest only mortgage. So like I said, it is a temporary solution unless you put them back. There could be so many different things. They cannot refinance their mortgage at a lower rate, or they're having so many different issues. I'm just trying to show numbers that at the mortgage that they have it at this time is 1.84. They may not be able to renew it, or they cannot take the equity out. That's why they have to take the second mortgage. But we are talking about all about cash flow over here, which could save families, which could save stress, which could save relationships. Very, very important for you to understand when you're talking to those people, what basically you're trying to do for them. Now, also debt consolidation, that's also improving cash flow. For example, a present situation for at this time, their unsecured loan of $3,000, right? They are going to pay approximately 90. Okay, majority of unsecured loans and credit cards, their payments are at 3% of the outstanding balance. So we are giving you example based on 3%. So credit cards are 18%. They let us say, oh, $14,000, their payment will be 3% of that 420, right? Not car loan, but it should be a car loan. Sorry for the typo. Lease is going to be $11,000. Typically speaking, they have $330, right? Other loans, let us say $12,000, payment is 360. If you calculate all of that stuff that they owe approximately $40,000 and their monthly payment will be approximately $1,200 per month. Guys, even if you Google on an average how much debt there is for on Canadians, it is $36,400, right? So we are taking the real life examples over here. Now, if you put all this debt that you're going to consider $40,000, right? And you even add 5% lender fee, which is going to be $2,000. You add broker fee, because this is typically going to be a second mortgage, $4,500, right? That's the minimum that we need to charge, right? And lawyer fee, because this is going to be less than 50,000, only one lawyer is going to be there, $2,000 approximately. Then the second mortgage, guys, even at 12% rate of interest, right? Total $48,500. They will add $8,500, but look at their monthly payment, $485, right? So to begin with, they will have $715 cash flow per month. Again, it could do exactly the same thing that we talked about, lowering down the stress in the families, managing cash flow, saving the relationships. So many different things can be done. And even if you look into that, just $715 multiplied by 12, right? So they are going to pay off this debt in the next about, I think, 5 years, right? But if you look into their credit cards statements, they will explain that how much time this is going to take to pay off the existing debt. And it is an eye opener, and you will be surprised to know that how much time this is going to pay if you're going to simply keep on paying minimum for the credit card loans, right? Now, creating a rental income. So let us say the present situation, someone has existing mortgage of 1.84, $450,000. Payment is approximately $2,100, right? So that's what they are paying at this time. But now let us see improved situation. They take approximately how much? New second private at 12%. Let's say they take $60,000 to do an additional unit to their home, or they simply want to finish their basement. So even new mortgage at 12%, right? $60,000 if they borrow, their payment will be $600, right? That's what is going to be. The loan will increase from 450 to 510, and payments will increase from 21 to $2,700. And guys, if you look into these, like into the stat these days, people cannot find additional units to rent. People cannot find finished basements to rent. You are going to have approximately $1,000 in cash flow per month, right? And in the next 60 months, that loan will completely be paid off. And then you will start making money on top of that, right? There's a $600 increase in the monthly payment, but there's a $1,600, and that's minimum. And Brampton, we have seen some of those people, they cannot find basements even to rent, but they're paying about $2,000 to $2,500 per month just for two-bedroom basement. Look at the different, they creating the rental income for your clients. It's simply to create value when people come to you, how you entertain them, how you provide different solutions to them. So that's very, very important. Kuljit, if you can please, sorry, Rashmeet, do you want to share some of your most recent files with the rest of the team?
Sure. I'll just share one of the files. So it's similar things, whatever Mahindra has discussed. It's just that it is a live actual example, like what I just recently did. So if we look at the left column, that's the existing what they have. It's actually in process. We still have to close this file. So existing is like first mortgage, they have it for 711,000. For the payment is 3685. I'm not touching this mortgage because it's with Duga. It's like a no frill mortgage where if they break it, like 32,000 of penalties are involved. Okay. And at the same time, a lot of debt is there, but we had enough equity in the house that we can consolidate all the debt and improve the credit. So the whole purpose here is to improve the credit so that we can go back, and by that time first mortgage will come up for renewal as well. We can combine and refinance. So always, as Mahendra mentioned as well, whenever we are doing a second mortgage, it is an interim solution. It's a short term solution where we are trying to see that what is the goal. Now, I always sell it like this only to the clients, that right now our credit is not that good. Debts are so much that we have to come up with a game plan where we consolidate our debts, improve our credit, improve our cash flow, and then later on we can go to a B lender to consolidate everything. In this case, if we look at it at the left column, car loan was 50,000 and their monthly payment was 827. CIB, they had a line of credit, unsecured line of 30,000, 225 was the payment they were making on that. They had various credit cards in total of 63,000 and making minimum payments of 1,050, had an existing second mortgage as well, and that was the reason they actually approached me, that they have an existing second mortgage coming up for renewal and they are charging a lot of fees. So when I understood the situation, I said the good point here is like we should not be looking at just renewing existing second. We should be consolidating everything so that we can improve the credit, rather than, because every time if you are just renewing your second mortgage, you are just eating up the equity. There is no exit strategy there. So here in this case, we came up with a plan where we are going to consolidate everything, make a single payment, improve our credit, and come next year when our first mortgage will be coming up for renewal as well, we consolidate everything. Many a times I do suggest our clients to do prepayment as well, just to get more cash flow. But in this case, we didn't have enough equity to do a prepayment for 12 months or any of the months. So we just stick to consolidating everything. So if you look at it on the left side, the total debts come out to be 233. 233,000, and total payments they were making was 3,000 approximately. And when we combined everything, leaving our first mortgage as it is, the combined loan was 233 again. But after adding all the fees as well, approximate numbers here, my payments were 233, $2,337. So there was a cash flow as well, a positive cash flow of 664. At the same time, this will give them time to build up their credit. And I also in this case suggested to close some of their credit cards, because here there were so many multiple credit cards which they were using to the maximum capacity. So whenever we are using our credit cards above 75% of their limit, they also bring our credit score down. So a simple scenario here, but it definitely helped the client. So mainly what we are looking is improving their credit, short-term solution, and then exit strategy. There has to be an exit strategy to come out of it. So Mahendra, over to you.
Okay, thank you very much. And Kuljit, if you can quickly please talk about investor disclosure so we can talk about. You there, Kuljit? Kuljit?
Sorry, I was muted. So for all the private loans, like individuals, we have to do the investor disclosures. If we are using MIC or any other institution who are doing the private mortgage, sorry, the second mortgage, we don't have to use the investor disclosure. So typically, it's a 2 business days whenever we have to do the disclosure, whether it's a private or we have any other mortgage, we have to present that to our clients. That's 48 hours. That could be reduced for generally other mortgages could be reduced, they can waive it off. However, in this particular situation, when we are going for private mortgage, there is a form. That's 1.2. We can reduce it. We have to send that over to the lender, and lender can sign it off that I'm reducing that time period from 48 hours to 24 hours. Okay, so 24 hours is chopped, and then the other 24 hours is basically for the lawyers. Somebody asked me the question, do we have a lawyer who can close the deal? Yes, we have many lenders, many lawyers who work with us very closely. And when we request, they work around the clock. It all depends upon the client as well. Sometimes clients are busy. They can't, see the client or see the lawyer. And we have nowadays, like they can do the Zoom meetings and everything. It could be, like a closed pretty fast when we have done it within 24 hours. So Form 1 is not required to be completed if the private mortgage is financed through a mortgage investment corporation. Like Bright Path, Don Paul is coming for the next, presentation is Dan Paul's. They are MIC. They don't need, 24-hour or 48-hour disclosure. Appraisals, typically, yes, appraisal is required. However, if the equity is huge in the house, it is up to the lender if they can do the inspection on their own. They waive it because they can go and have a look. Everything looks fine. Go for it. Okay, or they can go for review as well because there's another way of doing checking the equity. They can do the review check, but majority of the times we as a mortgage broker, we always ask for the appraisal. It is not about spending like 400 $500. It's for the sake of a peace of mind for us, peace of mind for the lender. And we have like special appraisals. Is some lenders, they have their own list, but we have few of the appraisers who can do the appraisal quickly, less than a day, like 24 hours. They can go and then have a look and give the appraisal report, and they're also approved with the majority of the B lenders as well. So mostly all mixed private lenders use their own list of approved appraisers. We cannot just go, okay, well, I have the original appraiser, can you use it? We can't. We have to see if that particular appraiser is on the list or not. So yes, a lawyer, as I mentioned before as well, we need a lawyer. If it's less than 50,000, one lawyer. If it's more than 50,000, then we need two lawyers. All legal fees and disbursement paid by the borrower. And some private lenders, they do ask for, oh, is there any cost to me if I lend the money? Everything is paid by the borrower, not by the lender. Material risk and compliance. We we know that each and every mortgage has some associated material risks, and in our mortgage alliance, Akal Mortgages, right, we have a list of material risks, right? In not this training, but in other training, normally we talk about the material risk. What are those, and which one is applicable to the private mortgages? Okay, especially in private mortgages, we have lenders. We have to disclose those potential risks to the lenders, and we have to disclose those to our borrowers as well. Okay, so interest only mortgage, no principal payments can put the borrowers at risk due to decline of the property values over time. Client could end up owing more than property is worth. Lender fee, broker's fee, penalties, NSF fees, discharge fee, administrative fees, and what happens at the time of mortgage renewal. All sort of fees need to be discussed in writing. Means they see that and they initial beside it. We just cannot say verbally, say he said, she said kind of thing. Everything is on the piece of paper. So know your lender investor forms to be submitted and approved prior to discussing private mortgage opportunity. What happened yesterday? Somebody called me that I want a second mortgage, but I have a lender. I said, okay, that's fine if you have a lender. So, talk to your lender or give our phone number to the lender so we can do the lender disclosure. So he or she could be our approved mortgage, private mortgage investor, and then we can do your mortgage. Okay. Form 1, private mortgage form must be signed by the broker, not the agent. Agent cannot sign that form. So we have brokers who can sign the form. Myself can sign, Rashmeet or Mahendrapal or other brokers can sign it as well. Mortgage life insurance must be offered, discussed, and attached to the file. No matter what, if they like it or not, you still have to have that form. When the file is complete, file cannot be paid until we have that form. They declined it, fine. If they don't decline it, they accepted it. Right away, you have to send that over to the head office. Okay, you cannot just keep that with you. Within less than 24 hours, that form has to be there just to safeguard yourself and the client as well. So that was the end of our today's presentation. Dan Paul is ready, I believe.
Hello, Dan Pauls.
Dan.
Yes, hello, how are you today?
Yes,
Good,
yes,
good,
sir.
good. Sorry,
Over to you now.
we have eaten up 15 minutes of your time. Sorry, we just want to make sure that we prepare the ground before you come on board.
Perfect. It was a lot of great information this morning. So
Thank you.
I was listening in the background, and some really great information shared. I'm going to be, reinforcing some of that in my presentation as well. So that's great. Am I able to share my screen?
Yes, please, you can.
All right, let me do that here. Okay. So hopefully everybody can see my my picture before, before COVID, when I still had short hair. I hope everybody can see that there. That's hopefully we'll get back to that at some point, but for now, things have changed a little bit. But thanks a lot for having me. I'm Dan Pauls. I'm with Bright Path Capital, and I'm really happy to be on the call to have this opportunity to speak with you all again. So today I'm going to do a sort of a two-part presentation. It's all about working with private lenders, and it fits really nicely with what you've all been speaking about today and in your own two-part sessions that you're doing this week and next week. So in part one, what I'm going to do is talk in general terms about how to approach a private deal, things to consider when you're submitting the file to the lender. I did a presentation similar to this one for you folks a while back, I think back in the late summer or fall. But so for those of you who are on that call, this might be a bit of a recap, but it does fit in nicely with what you're talking about today. And then in part two, I'm going to look at what you do once you get a commitment from a private lender, and how you go about selling the higher rate and fee to the borrower. Okay, so, and please keep in mind, there was some good conversation earlier in your presentation about the differences between different types of private lenders. When I'm talking about private lenders here with my presentation, I'm referring to any institutional lender or a MIC from my end. So those are the companies that engage in lending on a full-time basis. That's their only business. They have policies and procedures. They're audited because they have shareholders and investors. And as you guys discussed, that's very different than the individual private lender who might be a realtor or a lawyer, or just somebody who has extra money and wants to invest in mortgages. And there's a whole separate market for that as well. But for my purposes, we're going to be talking about institutional privates. So non-bank lenders such as Bright Path, FizGuard, Secure Capital, Apono, a lot of the ones that you would know. Okay, so let's get into it here. So once you come to an understanding that your deal won't qualify with an A or a B lender, the next step is to try to place it with a private or a MIC. And so if any of you are new to this type of lending, the great thing is there's a lot of, you're going to have a lot of institutional privates to choose from. They all have great BDMs who are more than happy to help you out and talk to you about your deal. So in terms of the pointers that I'm going to offer through this presentation, I've narrowed it down to 3 steps that pretty much cover what you need to do to have success with your private lenders. Okay. And these items are: number 1, you want to make sure that you know your client. Number 2, know your lenders. And number 3, know your exit strategy. And let's talk about each of these in some detail. So number 1, what does that mean? Know your client. The term know your client is brought up all the time, in the mortgage industry, within the financial services industry. And I would assume everyone here understands that they have a certain duty to know their client on every deal that they do. But now I'd argue that the duty to know your client becomes even more important on a private deal than it does when you're dealing with an A lender. And the reason is, when you submit a deal to a private lender, the underwriter that you're sending it to expects that there's going to be a challenge or two with that file. That's the reason you're sending the deal to a private lender, right? There's some kind of challenge there. So they're looking for that information in your submission notes right up front. Any underwriter is going to want to know early on exactly what those challenges are, because we want to make sure that we're the right lender to be able to overcome those challenges and actually be able to approve it and close that file with you. So there's a couple of things that you can do to demonstrate to your underwriter that you know your client. And number one is there. So you need to get a complete and up-to-date application every time. So don't just copy over an application, an old one from a year ago, and assume everything's the same. Often it's not. Something's changed with their income, their credit, their balances, what credit cards they have. So make sure that you're updating it every time. As soon as an underwriter notices that there's some outdated information on the file, you've probably lost at least a little bit of credibility in terms of the effort that they believe you've put into the deal. So please take the time each time to update the application in full. And then secondly, while you're interviewing them and filling in that application, you want to make sure you're asking the borrower open-ended questions. So remember, we're not just looking to fill in the blanks on the credit application. We're looking for the whole story on the private side, okay? And you're more likely to get that full story by asking open-ended questions. So examples of that would be, tell me a little bit about your credit history. Tell me about your income. Tell me something about your property, or describe your property to me. Anything like that where it's not a yes or a no answer. You're inviting them to give you extra information that you might not get from a standard application. And so you might uncover some more detail that's really important for you and your underwriter to know. Okay. And then once you've uncovered a challenge on your deal, make sure you ask the borrower about it. So you have to uncover the cause of those issues and any challenges you uncover to demonstrate that you really know your client and what it is that's led to their current situation. So how do you do that? You simply ask the question, why? Okay. I see on your credit bureau that you were behind on your MasterCard in the past. Why? Why did that happen? Why did you declare bankruptcy a couple of years ago? Can you tell me what happened? What led to that situation? Why were you off work for several weeks last year? Why did you miss that mortgage payment 6 months ago that shows on your credit bureau? All right. The why is really important. So many times we see on an application, customer or borrower was bankrupt in 2016. Okay, that's great. We can see that on the bureau. You're not telling us anything that we can't uncover for ourselves. What we want to know is, why did they have to go bankrupt? All right, so you get that point. And if you can address those types of issues in your notes up front, then those issues, those challenges will seem like much less of a red flag to the underwriter when they're reviewing the deal. Okay, so if you've already pointed out the issue and explained why it happened, then the underwriter is more likely to feel comfortable knowing that, okay, the broker understands this client. This is probably not likely to reoccur. They've explained it, and in their mind, they're comfortable moving on. All right, that's the confidence you want to put into the underwriter's mind, that you've looked into it and you know the why. And then finally, make sure you provide good submission notes. So it's really great that you've asked all these right questions, open-ended questions, you've asked the why questions, but now you need to demonstrate that hard work to the underwriter. So please take the time to tell the story of what the challenges are and be transparent about what caused them. Okay, so that's number one. It's really important that you know your client. Number two, you need to know your lenders. So once you know the client's story, your next job is to match up their situation and their challenges with the right lender that's able to deal with that. So you've probably decided at this point already that the deal's not going to fit with your more traditional A and B lenders, and so you've determined that you're going to have to go the private route. And so now the question in your mind becomes, how do you know which private lender is going to deal with that unique situation on the file? Okay. And the reality is, like you talked about earlier this morning, there's probably about 50 different private lenders and mix operating in Ontario, probably more. Each one has different preferences. Each one has different niches. To some degree, you're going to have to get familiar with a number of these lenders and the types of deals that they like, so that you know where to place your file. So every lender has a different level of risk tolerance. And the reason for the variance, really, it all depends on what type of portfolio they've sold their investors on. Okay, that's the reason for the niches. What are the investors that they've got comfortable in investing in? So they all view risk differently when it comes to things like the location of the property. So some privates like only the major cities, others will focus on rural properties. Loan to value, some will only go to max 75%. Others, like BrightPath, we're comfortable going to 90%. We've got a different risk portfolio that we're dealing with. Income, some will take stated income, others only want provable income. Credit, every lender has different minimum credit requirements, credit scores. Some lenders will consider GDS, TDS. Some don't care about it. It's not a factor in how they make their decision. And then property type, of course, that's important because different lenders will be interested in either residential, commercial, construction, land. You know, you have to know which lender is going to do that type of deal. Okay, so your job is to learn the niches of the private lenders so that you can confidently place your deal with the lender best suited to take on that deal. So again, the question becomes, how do you do that? And the reality is you don't need to memorize the lending policies of 50 different private lenders. I always suggest find 3 good private lenders that you enjoy dealing with, that provide you with good service, fair pricing, maybe ones that are doing a presentation for you today. You know, there's an example of one you might want to use. And, you know, the vast majority of private deals will likely fit with one of those 3 lenders. So how do you pick those lenders? Easy. You have to sort out. So how do you sort out who does what? You want to start out, first of all, by contacting the BDM. Any good BDM is going to be attentive and return calls and emails promptly, demonstrate that they want to help you do business with them and support your business. So first step is to use the BDM for that lender as a sounding board, to ask questions, to discuss a deal, make sure it's a fit. The BDM should always be your liaison to that lender and your primary contact when you're wondering whether a deal's a fit with them or not. Secondly, the next best thing would be doing meet and greets with the BDM. This was one of my favorite things to do prior to the pandemic that we're in. I'm looking forward to getting back to this again, where I can meet with brokers, whether it's one-on-one for a coffee or have lunch, talk about business, or maybe come into your office and do a lunch and learn meeting and talk about what we do in sort of that type of setting. So I'm looking forward to getting back to that as well. Lender presentations such as this one are a great way to get to know what lenders do, know their niches. Industry events, once we get back to doing those, there's all kinds of conferences, symposiums, trade shows. Those are all great opportunities to network with lenders and make introductions. There has been some virtual conferences that have been going on that I've found pretty successful. There's actually one coming up pretty soon as well. So that's an opportunity to meet with these lenders as well. Online referrals and chat sites can be excellent. Facebook has a great broker page called I Love Mortgage Brokering. And there's about 5,000 brokers on that from across Canada. And they're constantly asking each other questions and sharing information about different types of deals and lender products. So that can be a great resource. And then lastly, any solid institutional private lender should have a website with information that you can refer to. They should be able to provide you with broker kits, product sheets, or put you on their email list so you get updated with any new information. So lots of ways to learn about different programs. So that's number 2, know your lenders and where you're going to place that deal. And then finally, this was talked about by your group earlier today, and I can't stress enough how important this is to know your exit strategy. So once you've determined that you need a private lender, the next step is going to be determine how are you going to get them out of the private lender. Okay, so private lending is meant to be a means to an end. It's a short-term Band-Aid solution. Your goal should always be to move that borrower upmarket to a B or an A lender after about a year or 2, or whatever, as quick as possible, whatever that time frame is. So how do you make that happen? Most private deals that you get are typically going to be for a 1-year term. So you need to have some understanding of what's going to happen once that term expires. Okay. Are they ready for a B lender at that time? Are you going to have to renew them? What's going to happen after that year is over? So having that exit strategy in place will also make your deal more attractive to the private lender that you're sending it to. Any private lender, their business model is typically based on getting paid out after a year or two and then being able to re-lend that money to another borrower. So if you know that exit strategy, make sure you put that into your submission notes, whether it's, they're going to sell the property soon, or maybe it's even currently listed, which is great. We love short-term lending like that. Maybe they're renovating the property and then refinancing the mortgage at the new value. Or maybe you're committing to help the borrower improve their credit, or you're going to show them how to claim more income so that they can debt service down the road. Whatever that plan is, what's key there is that you make sure that the borrower also know what the plan is, right? So that you can hold them accountable to doing their part. They have to help out, obviously, to make those things happen so that they can qualify with a B or an A lender in the future. So the best you can do is provide the direction of what to do and follow up with them. But your client is the one that really and ultimately has to follow through with it and make sure that happens. So to recap again, the 3 steps to working successfully with a private lender are: number 1, know your client; number 2, know your lender; and number 3, know your exit strategy. Okay. And in any case, if you're ever submitting a deal to BrightPath, I'd ask that you begin by calling me. Let's make sure your deal is a fit. And I'm happy to walk you through the process to ensure that you have a successful experience. All right, so that's the last presentation. That's the end of part 1. Okay, so part 1 was a bit of an introduction, as you saw, to the world of how to work with a MIC or a private lender, and sort of, what your goals and your mindset should be when working with that file. So next, in part 2, we're going to look at things more from the sales aspect. So this one is about how to sell a private mortgage. And the sales part of being a mortgage agent, is really, really important. And I think it's one of the biggest parts of the mortgage agent job that probably isn't given enough attention. There's people that will be, have tremendous knowledge about lenders' product knowledge. They know every lender program inside out, and they're great at packaging a deal and getting the approval, which is great, but you don't make any money on any deal until that deal is actually sold and closed. So ultimately, our job requires us to be strong salespeople to be successful. And I think there's a lot of agents out there, some new, some experienced, who, may have some trouble with the sales aspect of the job and ultimately selling the higher rates and fees that may come with a private deal. Okay. Some people, it makes them somewhat uncomfortable. So my goal here in part 2 is to give you a few things to think about to hopefully help you in your sales approach with your clients. So again, I've got 3 points. These things always seem to work best in 3s. I've got 3 points that'll help you get more comfortable with selling private mortgages. And they are: number 1, you've got to believe in your product. Okay. Number 2, you have to be transparent about what you're selling. And then number 3, you have to sell your value as an agent and what you bring to the table. Okay. So again, let's look at each of these points separately and see what we mean by this. So believe in your product. When I say believe in your product, it's because the mortgage commitment that you get from the lender, what you're offering, the commitment that you're presenting to the borrower, you have to take that on as though that's your product. That is what you're offering. So if that's the solution that you decided to offer to your client, you have to feel good about the fact that you've done your research, you've explored all of your options, and you've determined that that's the mortgage product that you feel best fits with your borrower's needs and their current situation. And once you've gone through that process, and you believe that that's true, then you need to sell that with confidence, right? It starts with being unapologetic about what you're offering. So nothing will make your client feel less confident in a deal you're offering than if you start out your presentation by apologizing for it. Okay. You never want to start presenting your commitment by starting out with, before we begin here, I want to say, I'm sorry I couldn't get you a better rate, right? Or I know this isn't what you were hoping for, but let's talk about this. Or don't kill me when I show you this commitment. You can't expect a borrower to be excited if you use that kind of approach. And really the question becomes, why are you apologizing for the commitment that you're presenting? If you've worked your way from an A to a B to a private deal to get them a commitment, you've probably worked harder on that file than any other file you've worked on in the last couple of weeks, and your time and your effort is valuable. So don't ever apologize for doing the best that you can for your clients. And if all that time and effort that you've spent, then ends up with your borrower requiring a private lender, then you should feel okay about the fact that, that's what the borrower qualifies for, and you should deliver that commitment with confidence. So remember, and the last bullet here, I really like, this is really important. The pricing that your client qualifies for is not a reflection of you or your ability as a mortgage broker. Okay, that's really important because especially in terms of getting you comfortable with selling that kind of pricing. So I'm going to read it again. The pricing that they qualify for is not a reflection of you or your ability as a mortgage broker. It's strictly a reflection of the borrower's current situation, their current situation. So as soon as you accept that fact as a broker, it should take away any feelings of, boy, I really feel like I didn't do my job here, or maybe I didn't do the best I could, or I failed them as a broker. That takes all of that off your shoulders and helps you realize that this offer isn't about me or my ability. It's what the borrower qualified for, right? We did the best that we could. Okay. So rather than being apologetic about the pricing, you should really be celebrating the fact that you have an approval for them, and then circle back to their main goal in the first place. So were they looking to purchase a home? Were they looking to consolidate debt and improve their cash flow? Were they looking for an equity takeout? Whatever that goal was, you now have a mortgage commitment in your hand to make that happen. So really, you should be sure to present that with energy and confidence. And from there, the borrower has to decide for themselves and, do that mental cost benefit analysis in their head to decide whether it's worth it for them or not. So given the costs, do they want to go ahead with the mortgage? And all of us do that every day whenever we make a buying decision. If we're buying, if we buy a car, if we buy clothes, if we buy ourselves lunch, we have to decide, before we spend money, is this worth it for me? Do I see value here? And so the best you can do is show them the benefits of the deal that you're presenting. Does it get them to their ultimate goal, right? Is it a stepping stone forwards? So show them what the deal will accomplish for them, and then really, they have to decide from there. And then finally, you can sell a borrower on your product by sharing some stories or experiences from your past. Maybe it's a story that you've dealt with yourself or one that you've heard in your office from another agent, but tell them about the borrower that was placed with a private lender and that was, then able to get refinanced later with an A lender. That's a great story. That's the type of example that your borrower wants to hear. Or maybe there was a borrower that was, really struggling was about to lose their home, but you found them a MIC to refinance them and give them a fresh start. And now they've been able to stay in their home and move up market. And, all of those are really great success stories. And you'll want to share those types of situations with your client to make them feel comfortable with what the private lender can do. And again, to stress the fact that it really is just a short-term solution to their temporary problem. Okay. So again, number one, you have to believe in the product that you're selling. And then number two is be transparent. So as the mortgage broker, it's your responsibility, as you know, to disclose all the costs of the mortgage that you're proposing. And so not only does that eliminate any misunderstandings, or it prevents the client from feeling misled down the road, it also really shows that you're being upfront and that you're being transparent about every cost that's involved. Okay, it shows you're not hiding anything, and that you've explored all the options, and that you've done your due diligence before recommending the product, and you're putting all the costs and everything on the table to be seen. All right, so you want to make sure that you fully disclose things like the rate, the fee, the term, any setup fees, costs of legal and appraisal, your broker fee. But also what's important is that you disclose and find out, what is the prepayment penalty on this deal? What are the discharge costs? What are the renewal costs, if there are any? Don't leave any of those things out, because the last thing you want is for any surprises down the road where your borrower thinks that something was being hidden, and then they decide to, they get cold feet and they decide to cancel the deal. So be upfront about everything. And then while you're providing that disclosure to your client, that's also a good time to demonstrate support for the lender by giving the borrower, kind of a general explanation of how pricing works at a MIC, and why the rates and fees are where they are and why they're higher. So you'll want to let them know that with a private lender, there's typically investors that pool their money together to make these things possible. And those investors are willing to take on the additional risk. And so their return on their investment has to compensate them for that risk. Okay, so the higher cost of capital, the higher risk exposure, is what results in the pricing that you see. And you certainly don't have to be an expert in any of that, but it does help to have, at least a basic understanding of why private lenders have to charge the rates that they do. And it's all about the additional risks that are involved. Okay, and then lastly, always invite questions so that you can manage any objections that come up. Really, the more questions that the borrower has, it's evidence that they're more engaged in your solution, and they want to hear more about what you're offering. So it's actually it's a good sign if they have lots of questions, and you should really be welcoming those and inviting those to get all those possible objections off the table, and address them up front, so they don't go home with any nagging doubts about, oh, I wish I would have asked this or that. But again, you don't have to be an expert on every lender's product. You don't have to necessarily have all the answers up front, but you really should be an expert resource for your client. So what that means is, if you don't know the answer, you will jot down the question and then take it back and check with your BDM or your underwriter, and then get back to the client right away. So you don't have to know all the answers yourself, but you'll want to show the client that you'll find out all the answers. And then lastly, what's important is selling your value as an agent. So once you've given the client your sales pitch, you've presented them with the mortgage commitment, you want to show them that this is just the beginning of the relationship that you're hoping to forge with them. They don't want to be in that private mortgage for long, right? And you don't want them to be in the private mortgage for long. And the private mortgage lender doesn't want them to be in the private mortgage for long. So everybody wants the exit strategy. So this goes again to what we talked about in part one. What happens next? Most deals, terms will come due in a year. So again, what are your plans after that? And that always depends on the types of challenges on the file and what you're dealing with. But you really should be able to identify what those challenges are and kind of understand those timelines that it'll take to get them to a B lender and back to an A lender. Okay. And whatever that direction is, be sure to share that with the borrower, get them to commit to doing their part to make those things happen so they can move up market. You may even want to show them the criteria for the next lender that you have in mind, and exactly what they'll need to do to get there, and what they'll need to do to get approved. So here's where you put together a plan for some type of follow-up meeting after that mortgage closes. So hopefully you're currently offering 6-month checkups with your borrowers. And if you're not, I'd suggest that you do regular touch point meetings with your clients. And not only will doing that keep them on track and keep them accountable to, doing what your plan is, but you'll never lose that client to a competitor because you're building loyalty by continuing to reach out to them on a regular basis. Okay. So finally, what you want to do is always make sure that you're doing your best to create a trusted, loyal relationship with your clients. Ultimately, they should see you. Your goal is for them to see you in the same way that they trust their financial advisor or their doctor, right? And that is that once you make a suggestion or a recommendation, they should see it as coming from a place where they see you as looking after their best interests, and you're always presenting what's best for them. Okay. And then once you do that, you want to always celebrate their successes along the way. You've gotten them a mortgage approval. That's a great thing to be celebrated. And then once they improve their situation and move up market, that's also something that should be celebrated and encouraged. So help them to see the progress they're making, be part of those big moments. And that's how you build a relationship with your client that creates loyalty and generates referrals for you. And it allows you to have those tougher conversations with the client when life events happen and maybe a private mortgage is needed down the road. So that's the overall mindset and strategy that you want to have when dealing with private deals. Again, to recap, you want to believe in your product and what you're offering, be transparent about the costs and the terms of the deal, and then make sure you're selling your service and the value of the service that you're offering. And once you do those things, you're seen as a trusted advisor to your client, and it really does make the sales aspect of the job that much easier. And that's it for today.
Thank you very much.
Thank you.
I'm
very
much, Dan Pauls. You can also talk about your products. I think there's special going on your products as of now.
Yes, thank you. So right now we're offering, anybody that's on our email list will know that we have a special that we've been advertising where first mortgages are going out at 7% rate plus 2% fee. So when I'm talking about first mortgages, we're lending right up to 80% loan to value. And regardless of whether you're at 60% or 80%, we're offering 7% plus 2% fee. Also, whether it's urban center or in a small town, either one of those, we're still doing 7% rate plus 2% fee. So we're offering that flat fee pricing to make it easier for you to predict what your pricing will be. And especially at that 80% loan to value, 7 plus 2 is very aggressive in the private world. The only criteria we have for that is that we need at least one of your borrowers to have a Beacon score over 600. Doesn't matter so much what the other one is, but as long as we have one over 600 and obviously a residential property, 7 plus 2 is what we're offering. So give us a try for any of your private deals where where you need 80%, especially because that's a really strong offering. So yeah, that's where our pricing is nowadays. We lend in Ontario right now. We are doing a very soft launch into British Columbia very soon. So stay tuned for that. But right now we're an Ontario lender, and I look forward to working with this team. It's always great to chat with you.
Thank you very much, Dan Pauls. And I am going to post this recording into our Facebook group and as well as your contact information. So guys, Dan Pauls is very easily available, just a phone call away, just an email away. And I can tell you that his communication is very quick and very good.
Thank you.
Thank you very much, Dan Pauls.
Thank you.
We really appreciate you as a partner with the Call Mortgages. Thank you.
Likewise. Thank you.
Thank you, Don.
Thank you.
Okay, guys. So now, Josie, you there, please?
I am here. Hi, everyone. Just turning
How
on
are
the
you?
camera. How are you today?
Very good. And accept our apologies, running behind schedule. It's only 25 minutes behind for you, 2024. But we are glad to have you as our partner and helping a lot of our agents on daily basis. So over to you, Josie.
Thank you very much. Thank you, everyone. It's great to see some familiar faces and to see some new faces for sure. I'm really enjoying being a representative for ACAL here at CMI Mortgages, and I'm looking forward to meeting a lot more of your team for sure. Today, I wanted to talk about, and great presentation by your previous presenter. I just wanted to talk a little bit about how to sell a private mortgage. One of the uh, items that generally come up when I'm speaking to a lot of agents is how do I get my brokers my clients to understand the benefits of a private mortgage. So I'm just going to go very quickly through the presentation, and of course, if anyone has any questions, I'm open to questions at any time. So Canadian Mortgages, who are we? We're going to talk a little bit about who CMI is for those of you that have not dealt with me as of yet. What is a private mortgage? Why is it important to sell a private mortgage? And who is a candidate for private mortgages? A lot of times I hear agents say, well, my client doesn't qualify for a private mortgage. You'd be surprised which candidates do actually qualify for that. A lot of misconceptions on private mortgages and how we can overcome those misconceptions. Most importantly, how are we going to sell these private mortgages, and why should a mortgage broker be a private mortgage expert? We'll also talk on how to submit your deals to CMI and what the next steps are. So, of course, Canadian Mortgages Inc., we were founded in 2005. We have been focused solely on alternative lending, private solutions since 2015. One of the main things I want to stress is we are not a competitor to our brokers. You are our client. We operate exclusively with the broker community. You always retain ownership of your clients. Even on renewal, we will inform you 90 days prior to the renewal date. Your client is coming up for a renewal. You should touch base with them and find out what their next steps are. Are they ready to be moved to a B lender? Are you going to be moving them to another private lender, or are they just going to renew with us? So what is a private mortgage? As you all know, a private mortgage is a short-term solution to your client's needs. The loans can range anywhere from 6 months to 3 years. Typically, our mortgages are only for 1 year. We have launched the ability to offer 2-year terms on loan to values under 80%. So if you do have a client where you want to match up their maturity date to an existing first, or you think your client needs a 2-year term, always bring that to my attention and we can see how we can fit that in for your client. As a private lender, we're not affiliated with a bank or any sort of traditional lender. We don't have the same financial regulations. That means that we can look at your deals and think of how can we get the solution to your client that you're looking for. Why is it important to sell a private mortgage? There's so many reasons why. More and more clients are actually in need of private mortgages in today's market. The good thing about private mortgages is they're very flexible. We don't have the same rules. We don't have the same guidelines. We don't worry too much about beacon scores or TDS and GDS. It really is about our own guidelines, and the two important aspects of a private mortgage. The property, obviously, that is the number one. Do I have a marketable property? And the other thing is, what is the capacity to pay? How do we know the clients are in a position where they will be able to make their payments? The last thing we want is to put a client in a situation where they cannot make their payments. Another thing is private mortgages offer an immediate solution. One of the big things about private mortgages is to know the why. Why do they need the private funds? What is the ultimate goal of your client? We can offer that solution and get for a short term to get them out of the situation that they're in. As a mortgage broker, you could definitely close more deals with a private lender. We're open to getting these deals closed as quickly as possible for you. And it's an alternative option for your clients that just don't fit into those traditional institutional lender rules or qualifications that are out there. Also, as a mortgage broker, it can be very lucrative to be selling these private mortgages. How do you identify clients that are going to benefit from private mortgages? So many clients can qualify for a private mortgage. You have clients that owe taxes to CRA. I'm doing several deals right now where a client is an A client, but they will not pay out their CRA taxes that are owing. Brokers are coming to me for short term, 3 months or 6 months. We're paying out those taxes, those outstanding CRA debts. They are presenting the receipt to the A lender, and they're just refinancing very quickly. We can pay out any liens, we can pay out debts that are in collections to help these clients to improve their credit proposals. I believe there's a rule that once you pay out a credit proposal, it comes off the bureau within 2 years. So that might be a client where we pay out the credit proposal, we help them to reestablish their credit. In 2 years' time, that credit proposal is removed from their credit bureau and you can move them into a B lender. We can debt consolidate, we can improve their credit scores, we could settle a divorce or a separation. Right now, in time of COVID, we are dealing with a lot of clients that are in between jobs. They're currently on CERB. We can bridge that gap for them. We can prepay the mortgages for them so they don't have to worry about their payments while they get back into the job market. We look at real estate investors, house flippers, self-employed individuals that work mainly in cash or who have not filed their taxes in several years. We look at financing some unique properties, rural properties, farm properties. We do consider properties that are currently going through construction or doing large scale renovations. We also help those that are looking for a short-term loan. We offer bridge loans. And of course, there's those AAA borrowers. They're locked into a fantastic rate. There was a presentation about half an hour ago where they were saying, their first mortgage is at 1.85 or 1.65. You wouldn't want to pay that out. But their credit cards are at 21 or 22%. By refinancing them into a private mortgage, we can pay off their debts, lower their monthly payments. And keep in mind as well, at CMI, we offer interest-only payments and we also offer amortized payments. So your clients can actually make payments, principal and interest payments, on their private mortgages so that they can start putting a little bit of dent in that outstanding balance. It is very important to know your client. You need to always be kept up to date with their information. Are they married? Do they have children? Are they working? Where are they working? What sort of income verification can they provide? Make sure you know your client. Make sure you ask them the questions. If you are looking at a proposal or a bankruptcy or derogatory credit, ask the question, what happened? What got them into that situation? Always ask them why they need the funds. A lot of equity takeouts are happening right now, $150,000, $200,000. We need to know why. What exactly are they doing with that money? Is it for investments, RSPs, renovations? Always back your application up with a story as to what is happening. Make sure you know the whole story. I know sometimes clients will say, well, I don't think that's any of your business. It is your business. As a broker, it is very important that we know our clients. It's very important that you know your lenders as well. So always keep that in mind. There are so many misconceptions about private lenders. Our rates are too high. There's no way a client will ever accept a rate that is high. Again, your job as a broker when it comes to private mortgages does not have anything to do with the rate and fee. It has to do with the solution. Are they trying to get out of a bad marriage? Are they trying to consolidate their debts? Are they trying to free up equity from their home? Don't start your conversation with, I can offer you 599 and 2. The conversation should start with, how can I help you? How am I going to make this easier for you? How am I going to get you to where you want to be in 30, 60, 90 days or 3 months to a year? That is our main priority when it comes to selling private mortgages. The fees are too high. Well, no, they're not too high based on our risk. We have to explain to clients as well, especially when we're in a second position or if we're dealing with someone that doesn't have the income to qualify, we're taking on the risk by lending them this money. A lot of clients are worried about renewals. 99.9% of our mortgages are renewable. They have to be in good standing. And even when they're not in good standing, we always try to come up with a solution for the client. We might refinance them. We might make it a prepaid mortgage. So we do process renewals, absolutely. All of our penalties are disclosed on our commitments. It's our responsibility to make sure that there's full transparency on all of our mortgages. We do not only lend on clients with bad credit. Good things happen to bad things happen to good people. I should say that the right way. Bad things happen to good people. And we always have to understand that, yes, there are those clients that have the bad credit, they're in a bad situation, but there are also clients that have very good credit. And for whatever reason, they are not able to qualify. We can give them that short-term solution until they can get to where they need to get to. Applications in our office, at least, take less than an hour to process. Once you have an application and you send it in to us, I'm sure those of you that have dealt with me can attest to the fact that within an hour, I'm already calling you back. I'm already answering your questions. I'm answering your text messages, and I'm coming up with an approval or a decline, or at least a conversation on your application. It can be that quick. Private loans and mortgages look bad on the credit bureau. I have not come across any private lenders that report their mortgages on a credit bureau. I can attest to the fact that CMI at this time does not have any plans to, or does not at this time report on the credit bureau. So that should not be an issue whatsoever. So tips on how to, again, the biggest tip I can give on how to sell a private mortgage has been and has always been to focus on the solution. Focus on how you're going to resolve the issue at hand, and make sure that you understand what the client's ultimate goal is when you are providing that solution. Always reinforce that this is what we're trying to help you with, and also reinforce the fact that this is a short-term solution. You don't want your client to be in a private mortgage paying high fees or high rates perpetually. You want to be able to get them out of the situation that they are currently in. Always focus on the exit strategy. You should always have an exit strategy, whether it's a private deal or a B deal. Your goal is always to get the client to that next step. What is the exit strategy? It could be that they're going to be selling the property. It can be that we are going to refinance with an institutional lender when their current situation has been resolved. They might be looking at selling an investment. Always discuss that exit strategy with your client, because that should be their overall goal. If their overall goal is to sell the property, what steps are they going to take to make sure the property is marketable and will sell at top dollar? If it's to refinance with an institutional lender, what steps are you and the client going to take to make sure that they're ready to be brought into an institutional lender? And if they're going to sell off investments, of course, they should be speaking to a professional that can guide them through that. So why should you become a private mortgage expert? The one thing is client loyalty. Once you've helped a client through a very difficult time, or you've helped them come to the realization of their dream, regardless of what it is, not only will they become loyal to you, they will always refer you to clients. The better satisfied they are with their customer experience with you, the more they will refer. They are more likely to make referrals to your business. Also, private mortgages result in more business coming through to your desk, which makes for a larger base of clients and will help you to grow your business. You should become a private mortgage expert because, and I always use this analogy, I have a lot of brokers that call me and say, I'm co-brokering a deal. And my first question is, I will call them and they'll say to me, I've got this deal, it's a private deal, but I don't understand these private deals. I've given it over to agent B. And my response to that is always, I don't understand. If you wanted a Starbucks coffee, would you go to Tim Hortons and ask them to go across the street and ask for the Starbucks coffee? No, you would walk over to the Starbucks and get your own coffee. Private mortgages are the exact same way. If your client needs a private mortgage, Become the expert. Know how to sell these deals. Know how to package these deals. And most importantly, know how to talk about your private mortgages. You shouldn't be farming them out. You shouldn't be giving them to other individuals. These are your clients that are going to be very respectful of your time, and they're going to be very grateful for everything that you have done for them. You can qualify your clients much more quickly through a private lender. We can fund quicker. I know I've seen a couple of deals from your office as well, where they need to close a purchase in 5 days. I know for a fact that these A lenders, they just don't have the time or the capacity to do so. So we can close these deals quicker for you, resulting in increase in income on a quicker basis for you as well. So how do you submit to CMI? We are on Philogix, we're on Velocity. Any deals can be submitted through either platform. Lender type private, and you would always look for Canadian Mortgages Inc. Once you send the deal in, automatically direct it to me as your representative here at CMI. And again, our SLA to you, our preferred broker partner, is to get back to you with a response within less than an hour. And I definitely do try to adhere to that for sure. Our products, we have first mortgages, second mortgages, and our bundle products. Our first mortgages are now starting at 5.49. Second mortgages are starting at 6.99. Every deal is about a conversation. My bundles can go as high as 85%. So whenever you have a deal, you know, this lending matrix is a guideline only. Call me, tell me what you need. Do you need a lower rate? Do you need a lower fee? Do you need a higher loan to value? The more we can talk about the deal, the more I can understand what your needs are to sell the deal to the client, the more quickly I can come to you with what it is that you're asking for. Next steps, I am going to make this presentation available to all of you that you can easily refer to. You can always email all of your questions to me or call me. I'm always a phone call away. And for sure, submit those deals through Philogix or Velocity. And I am really excited to continue this partnership with the Cal Mortgages. My contact information can be found here. But again, I will be sending out this presentation email to everyone that's attended today so that you've got that contact information at your fingertips. Thank you, everyone. I appreciate your time. If anyone has any questions, I can definitely answer them for you.
Thank you, Josie.
Thank you, Josie. First of all, wonderful presentation.
Thank
you
you.
very much. And we are very proud to have you as one of our main partners at Call Mortgages. You are helping a lot of our agents in a very short period of time. And like, as you said, speed does count. And
Yes.
the second thing, the outcome is that our team members are making good money. It's a lucrative business to do that. It
Absolutely.
also comes with responsibilities, but we are glad to partner up with you. Guys, any questions for Josie or ourselves? We are going to be here for 2 more minutes. So all of your questions are welcome at this time. Any questions? You can either write in chat or you can unmute yourself and you can ask yourself. Any question?
You have a quiet bunch today, Mohinder and Kulji. It's a very quiet bunch.
Yeah, majority of the questions has been answered already.
Yes.
And
there were tons of questions coming in chat, and we have answered all of questions in the chat. But again, guys, you are free at this time. So
don't be shy to ask questions.
Yeah, that single city question that you think could end up making you $8,000 to $20,000 in commission.
Exactly.
Right, Josie?
Yeah, absolutely. Absolutely. It's my job to make sure these deals come in and close as quickly as possible.
Yes.
I won't put anybody on the spot, but of course, as you all know, and as I've said several times, I'm a phone call away, I'm a text away, I'm an email away. Please feel free to call me at any time. And hopefully once this COVID is all over, we can meet in real time, face to face, which is always very nice. But again, Mohinder and Kuljit, thank you very much for inviting me today. I really do appreciate the time.
You're
Thank
very
you
welcome,
very much.
guys. So we are going to conclude today's webinar, and we will continue this private mortgages webinar next week as well. And if you have any questions, please reach out to any one of us, and we will be more than happy to provide you the information that you need. You can reach out to our BDMs, you can reach out to us, and there you go. Thank you very much. So,
Thank you.
bye.
Bye-bye.
Thank you, everybody.